Welcome, ladies and gentlemen, from me, Guy Munson, to our regular 6-minute strategy summary. We're going to look this week at what could go wrong for financial markets. Where are the risks? Why are we nervous? Because we're hitting new highs again across world markets. Lifetime highs for the S&P 500, for the European Stoxx 600, and for world equities overall. And that makes us think of the risks. 3 areas particularly worry us. First of all, this extraordinary economic recovery in magnitude and vaccine progress is incredible, but it's very uneven. Secondly, we'll look at inflation risks around the world. Supply chains are fragile, shortages in critical commodities, even in semiconductors. And thirdly, we'll look at excesses in the markets themselves. Record levels of issuance in high-yield bonds and in equities, the use of SPACs and other special purpose vehicles heightening risk. All of this occurring with volatility hitting new lows for the past 12 months. We'll try and work out what this means for asset allocation, where are the protection points that we can introduce in your portfolio, and look at strategy for 2021. So let's begin by looking at market performance 2021 to date for a UK investor. World equities up 8% to new highs, as we heard earlier. UK gilts down by 6%. So a 14% difference between bonds and equities in just 3.5 months. Gold rallying a little, but still down 8% for the year to date. On the right-hand panel, you can see the battle between value stocks and growth stocks worldwide. Value still leading for 2021 to date, but a stronger performance from growth in the last few weeks, as we saw very good numbers again from many of the tech stocks reporting. On the bottom of the panel, the VIX index, that's the volatility of S&P 500's equity returns, falling to new post-COVID lows. And it's those new highs and that low volatility that makes us worry a little bit about some of the risks that are in markets today and whether they're well priced in. Let's begin first looking at the unequal recovery and what that means for potentially divergent economies. On the left-hand side, I've shown year-on-year growth. The new Chinese data just come in, up 18% from 12 months ago. Obviously, that was the worst point for the Chinese COVID crisis. But you can see the difference in returns from other markets historically. Japan 1.3% smaller, the US 2.4% smaller, the UK the worst at 7.3% smaller. Now, these numbers are going to change hugely as the recovery comes, but you get an idea of the divergence. And that divergence is going to persist because of the difference in vaccination rates globally. Look at the speed of the US program. Then Germany, 22% vaccinated. Then we drop to the emerging world. Brazil, 14%. China, 12%. India, 8.3%. Somewhere like Nigeria, just 0.47%. Hardly begun the program at all. And that holds risks not just financially, but it holds risks, of course, of new variants emerging in unvaccinated areas of the world. The IMF worries about this and calls it a recovery that is diverging dangerously across countries. And it looks at some of the pain that's already being felt in the developing world. An additional 95 million people added to the extreme poor, 80 million more undernourished. You can see the effects of this on the left-hand side if you look at the longer-term growth outlook to 2024. The IMF has compared the numbers pre-COVID and post-COVID. For the US on the right-hand, that right-hand blue bar, actually accelerated a larger economy than it would have been ex-COVID because of the effect of this vast stimulus program. Compare that to emerging Asia ex-China, that blue bar falling by 8%, or Latin America or Sub-Saharan Africa falling by 6%. And you can see this hugely divergent outcome emerging versus developed world. I take just one other example, education. The IMF show here that around 50 days is the average of educational time that has been lost because of the crisis. Only 10 or 15 days in the West because of teleworking, and 70 days in the low-income economies. So many other indicators show a similar message. My second worry, as we talked about last week, was rising inflation. The ISM manufacturing prices paid number up at 85.6, that's a 10-year high. Look at the China container freight rates soaring as supply chains are fragile across the world. All of this means a hopefully transitory flow through of inflation, as you can see on the right-hand side, into US headline CPI, surging well over 3%. And we hope that that will settle back to 2 to 2.5%. But if it isn't transitory, there is risk of an early taper by central banks and volatility in bond markets. Third and finally, I worry about excess in equity and bond markets themselves. The IMF has charted here on the left the volume of high-yield bond issuance, an all-time record. Now, in one term, since that's good, that's weak companies refinancing post-COVID, but it's adding to financial risks around the world. Similar numbers on the right for global equity issuance, again an all-time record. And look at that black line, that's the volume of US listed SPACs, that's special purpose acquisition companies used to make speculative acquisitions. That's an indication of the sort of risk that's evident in the market. We're seeing it in other areas. The number of call options is soaring. The number of off-exchange trades that are being done is soaring as the retail investor trades online. All of those give me concern that there's potentially more risk out there than markets are perhaps pricing in. So what are we doing at Sarazen and how can we use asset allocation to mitigate this? One, we're strongly underweight government bonds. Now I know they rallied a bit this week, but that offsets some of that inflation risk. Two, in equities, we're using portfolio insurance. We're running higher cash balances. We've got a quality overlay in what we select. That mitigates some of the risk in the high issuance we're seeing today. For emerging markets, we're underweight EM ex-China because, unfortunately, this slow vaccine rollout is going to hurt economic growth. Against all of this, we're beginning to add to our gold positions, which, as you saw earlier, have been relatively weak as a stabilizer in our portfolios. So I hope that helps you. I hope those risk mitigation measures are understandable and you can see where our asset allocation is leading for 2021. Thank you.